We'll just give people a couple more seconds to join. Okay, it's 3:02 and I'm conscious of everyone's time, so thank you for those of you that are here on time. So we'll get started. Good afternoon, everyone, and a very warm welcome to the James Cooper Creston webinar around avoiding the wrongful trading trap. I'm delighted to be looking out of my window today to blue skies and sunshine, and maybe the summer has finally arrived. But what is the long-range forecast for UK business? Challenging times ahead for some, I'm sure. I'm joined today by Sandra Munday and Tom Russell, who are both fully qualified insolvency practitioners and have a vast amount of experience and knowledge to share with you today. I'll just be asking all the silly questions. That is, of course, unless you have any. And if you do, there's a Q&A button at the bottom of your screen. Please feel free to tap any questions in there. And we'll cover off as many as we can at the end. So without further ado, Sandra, I'll come to you first. And could you tell us exactly what wrongful trading is, please?
Thank you, Jenny, and good afternoon, everybody. Wrongful trading is defined in the Insolvency Act 1986, so it's quite an old bit of legislation now. And just a quick recap for, or a refresher for those people with us on the webinar. So it applies when a company has either gone into an insolvent, liquidation or administration, and the liquidator or administrator looks at the conduct of the directors to ascertain whether they are culpable of wrongful trading. And what they look at is whether the directors knew or ought to have concluded that there was no reasonable prospect that the company would avoid going into an insolvent, liquidation or administration. If that was the case, whether the directors took every step with a view to minimising the potential losses to the company's creditors, which is the director's defence to wrongful trading. So the new or ought to have known test, or taking every step test, will also take into consideration what a reasonably diligent person might have done in the circumstances with regard to general knowledge, skills and experience of what might be expected of the reasonable director in that position. But it also looks at the specific director's general knowledge, skills and experience. So for example, if the director was also a qualified accountant, there might be a higher expectation of them having a greater understanding of the financial position of a company than, say, the sales and marketing director, for example. If wrongful trading is proven, and it usually results, that would usually be as a result of a court case, then the directors may be asked to contribute to the company's assets. Another important bit of information there in relation to legislation is the definition of insolvency. So the company has got to be insolvent for wrongful trading to apply. And there are two tests for insolvency. Firstly, the balance sheet test, which is looked at whether the level of the liabilities are greater than the value of the assets of the company. And the second test is the cash flow test, which looks at whether creditors can be paid as and when they fall due. And if either of those tests show insolvency, then potentially the wrongful trading provisions kick in on a liquidation or administration.
Okay, thank you very much. Very thorough there. Sometimes it helps to sort of bring something to life if you've got like a real life case to talk us through, and I think you've got one of those for us.
Indeed, and a number of people on the call are probably likely to know a reasonable amount more than this than I am, but I'm going to look at the case. It's a fairly recent case, being 2016, of Rolls Builders, where Mr. Justice Snowden actually was the judge on that case. And I'm going to try and go through some of the salient points now, and then later in the presentation we'll seek to apply these points to the new pandemic-ridden world, and when the wrongful trading provisions or the suspension is lifted, and what that might mean for directors. So Rolls Builders was a company that was a building company on the South Coast. There was an accusation by the liquidator that the directors had allowed the business to continue to trade wrongfully during a period of either starting on the 31st of July 2010 or the 31st of August 2010 through to the 13th of October 2010. So that's somewhere between 43 and 74 days, not a long period. They claim that during that period, the creditors had lost out to the tune of 1.3 million, and this was reduced during the trial to somewhere between 600,000 and $1 million. The director's defence to that allegation of wrongful trading was that they were awaiting an investment that would have turned the company's fortunes around. The trading on did not adversely impact the creditors, and they were relying on the advice of an insolvency practitioner. So what did the judge have to say about this? Firstly, he turned his mind to whether the company was insolvent, and he commented that it was heavily insolvent balance sheet, and the directors knew this when they received the draft audited accounts for the year ended October 2009, and they received those accounts in June 2010. The directors were also aware of significant creditor pressure from both HMRC and unsecured creditors. So the judge concluded that by the 31st of July, that the directors ought to have known that the company was insolvent, and indeed had been insolvent for some time. So he then turned his mind to whether the directors, having realised that they were, should the directors have realised that there was no prospect of avoiding an insolvent liquidation, having established that it was indeed insolvent. So he referred to another case here, and he quoted, "The answer to this question does not depend on a snapshot of the company's financial position at a given time. It depends on the rational expectations of what the future might hold." He also went on to say that the directors are not clairvoyants, and the fact that they fail to see what eventually comes to pass does not mean they're guilty of wrongful trading. So he then looked at what reliance can be placed on the professional advice that the directors received. So as I said, they had been taking advice from an insolvency practitioner, and there are two letters that insolvency practitioner wrote at the beginning of August, at the 2nd and 6th of August 2010. And the judge concluded from those letters that there was not evidence to suggest that there was wrongful trading, and that it was reasonable to continue to trade whilst pursuing the investment, although the directors should give their efforts to obtain the investment in only a limited period to succeed. By what date, he then thought, should the directors have concluded that there was no prospect of avoiding an insolvent liquidation, and was it appropriate to continue to trade? So by the 31st of August 2010, he said the directors ought to have concluded that there was no hope of avoiding an insolvent liquidation. But whether it was appropriate to continue to trade for a period was only applicable if that was going to increase, was not going to increase the net deficiency to creditors. So trading on between the two dates, as long as it wasn't increasing the net deficiency to creditors, would have been okay. So can the directors rely on the defence that they took every step that they ought to have taken with a view to minimising the potential loss to creditors? Well, the judge said it was a very high hurdle every step, which is absolutely right. So if the trading had been designed to decrease the net deficiency, then there would be nothing wrong with that. And the directors would be entitled to receive, and he also said the directors would be entitled to receive reasonable pay during that time. So if they were managing it during that time, they could be paid for what they were doing. But in this case, the judge didn't consider that the directors had taken every step. So you'd have thought of by now that the liquidators were pretty much home and dry on their points. But then the judge turned his attention to, did the wrongful trading cause a loss to the company? Now, here the directors contended that the company was substantially in a very troughful period of its trading, and that credit had already been incurred for the majority of works that were being undertaken. And an immediate cessation of trade would have left contracts unfinished and customers entitled to withhold payment. And they also said that it would be better to collect contract debts outside of a formal insolvency process. So they contended that it was in the creditor's best interest to continue to trade during that period. So did the trading on between the end of August and the midpoint in October cause a loss to the company? Well, the judge wasn't satisfied that on the balance of probabilities that the continuation of trading by the directors after the 31st of August caused any or material increase to the net deficiency of the company. It was more likely that there was a modest improvement to the deficiency. So eventually the director's argument was accepted by the court, although the judge did comment that he felt that the real sin of the directors in this case was the manner in which they continued trading facilitated the repayment of the bank and some of the existing creditors, whilst leaving new creditors unpaid. This was not something that the directors ought to have permitted to occur, but this does not justify a contribution to be made to the assets under the wrongful trading provisions, although he did allude to the fact that if he were listening to a case about preference or potentially fraudulent trading, that might have been relevant. Hopefully that helped on the understanding a little bit there, Jenny.
Yeah, I'm quite surprised how many different factors there is that the judge would consider in such a case. So yeah, that's really useful.
Yes.
Another phrase that I've heard is trading while insolvent. Is it useful to just distinguish between the two here?
Yes, indeed. There are a number of businesses at any point in time that will be trading whilst insolvent. Now, a lot of those businesses will be able to turn the situation around, repair their balance sheet, stop the creditor pressure go away, and that they will be restored to a solvent position. But during that period of trading whilst insolvent, the directors are liable to that personal liability potentially if things go wrong and wrongful trading action is taken. So it's not illegal to trade whilst insolvent, it's just that the risk that the directors are taking on is greater. So for example, if you had at the moment, if you were director of a printing company that specialised in printing flyers for festivals, they'd have had a pretty hard last 12 months and they may well have taken on a lot of debt into the business to continue that business trading. So the balance sheet today could be insolvent, whereas pre-pandemic it might have been quite a healthy balance sheet. Now they may choose to trade on for the next, say, 6 months to see how things go. Now, if things go well and the balance sheet is repaired in that time, or they get an additional investment in, yes, they may have been trading whilst insolvent, but there will be no consequences for the directors. Whereas if they, in 6 months' time, they actually say that it hasn't worked out as we hoped, and they now need to put it into liquidation, a liquidator or administrator will look back with the benefit of hindsight to say, well, did the position get worse for creditors? So as of today, the net deficiency on the balance sheet might be, say, 100,000. 6 months' time, it might be 500,000. The liquidator or administrator will look to see if that increase in the deficiency to the company's creditors of 400,000 is related to the wrongful trading actions of the directors.
Okay, thank you. Well, thanks for that, Sandra. That's really good background on sort of what we're talking about today. I'm going to come across to you now, Tom. The wrongful trading provisions were suspended last year. When was that?
Oh, good afternoon, everybody. Well, I'm sure some people are aware that as part of the corporate governance and insolvency legislation that was brought in last year, as part of the government's response to the pandemic. It was suspended from March last year, initially until the 30th of September last year, and it's since been extended again.
Okay, and why did the government do that, Tom? It's perhaps useful to talk around that a bit.
Yeah, well, this is the why is quite interesting, and actually the government on their website explain why they thought it was necessary to do this. And I suppose you've got to cast your mind back to March of last year. We were just going into lockdown. There was no vaccine, or vaccine was a distant hope. There was no idea of how long it might last, and there was huge uncertainty. The furlough scheme had just been brought in, and the government give an example of a pub, and it's interesting they use a relatively small company, but they give an example of a pub, and they say that pub was forced to close in March as part of the lockdown measures, and that the board of the pub come together and they decide that if the business can reopen in the June of the summer of 2020, then they think everything will be okay. They can take advantage of furlough. They'll get the majority of their summer trade, which is when they make most of their money, and the business will survive, is their belief. However, they think if they can't open in the summer, then the company will be forced to go into a liquidation. It still has costs for rent, it has some utilities, it has payments to the brewery, and it has other costs. And the cash reserve by that point will be exhausted, and they don't think anything they'll be able to do over the winter will make up for that. So it will be insolvent. So what the government has done is almost put themselves in the shoes of those directors, and wrongful trading expects directors to make reasonable decisions. And I think what the government have said is, well, actually, if you put yourself in the shoes of those directors in March, you have absolutely no idea whether or not you will be able to open in June. And they do not want the board of directors of a company to, I suppose, err on the side of caution by closing that company down with all the negative connotations that would involve, to avoid the possibility of an insolvency practitioner coming along at a later date and criticise them for wrongfully trading. So the government suspended the provisions, which gives the directors room to make a decision without risk of personal liability, recognising the hugely uncertain economic landscape at that time.
Absolutely. Yeah. Okay. Thanks, Tom. Attendees, we got a little poll for you. So it'd be interesting to see just what your thoughts are. Hopefully it's popped up on your screen. Were the government right to suspend the wrongful trading provisions last year? Quite nice and straightforward, yes, no, or don't know. But be interested to see just what people think on that. And while people are pressing those buttons, the suspension, Sandra, is limited. When is it due to be reinstated?
Yeah, it's due to come back the 1st of July 2021.
Okay, so not long to go then. Bearing in mind it's the 1st of June next week, so the 1st of July will be coming along fairly quickly behind that. Have we got the results of the poll there? Excellent. So just about 70% of people do think it was right to suspend the wrongful trading. And I think we would agree with that as well at James Cooper, that it gave business owners a bit of peace of mind to know that they could try and do what was right for the business. Bearing in mind, I think in March we were going to be closed for 3 months, and then in June we were going to be closed for another 3 months, and then in September another 3 months. So it has been if we'd been told in March last year we were going to be closed for 18 months, then we might have had a different situation now. But yeah, interesting. Thanks for that, guys. So what are the implications then from the 1st of July when everything is back on the table again?
So from the 1st of July, when we see insolvencies over the coming months, we will look from the 1st of July 2021 to see if the directors should have allowed the business to continue trading. beyond the lifting of those suspensions. We will also look obviously back at the pre-pandemic era to see if there was wrongful trading there as well. So from the 1st of March 2020, there was a very short period in the middle of that where there were no provisions. Again, they'd been lifted, the suspension had ended and the new extension hadn't started. So there's a small gap there. And we will be looking back with the benefit of hindsight. I know the judge commented that, directors aren't clairvoyants, but it's the only perspective that a liquidator or administrator can look from is the benefit of hindsight.
Absolutely, yeah. So 1st of July is a really important date. What sort of things should directors be considering at this time, do you think, to make sure they're best prepared?
Yeah, well, I think their balance sheets for some businesses will look very different to the pre-pandemic period. So they may well have taken on a lot of debt during that time. There may well be bounce back loans, CBILS loans, deferrals of VAT and other taxes, which are now being paid on an instalment basis, potentially increase in overdraft facilities. So the balance sheet of a number of businesses will look very different to the pre-pandemic position. So it's really important for businesses, I would say, to bring their accounts up to date. So you know what the starting position is. You know, if you're in a net deficiency situation, what the net deficiency on that balance sheet is. And a lot of businesses won't be used to, or certainly on the smaller scale, won't be used to receiving accounts very regularly. They might get quarterly accounts, they might just have their annual accounts. But I would say bringing those accounts up to date so that you know what your starting position is will be important, because if it does eventually fail and there isn't that balance sheet, well, you can guarantee that us as insolvency practitioners will recreate that balance sheet, and it will be our starting position, not the directors. But it's also really important to have forecasts. And I know those are going to be really tricky to actually to predict going forward for some businesses, but I think it's your best estimate. And therefore, and then once you've got those forecasts, monitoring your trading performance against those forecasts. And if things are going well, great. If they're not going so well, perhaps you should be taking some advice at that point in time to see what it is you should be doing as directors. And it will also a bit depend on how you've spent the money. If you've got money in, say, from a bounce back or a CBILS loan, if you've used that money to fund losses, then obviously the balance sheet won't look so good. But if you've used that money to invest, I mean, I don't know, it might be a pub and you've used your bounce back loan or your CBILS loan to invest in that pub, you've put in, you've had a refurb, or you've put in additional facilities in the garden, for example, then maybe going forward you're looking at a much brighter future. But if you've just used it to fund losses, then maybe it's much more tricky for you.
Yeah, just coming back to the point you made about the pub, I guess some businesses have had to invest quite a lot of money into what they might look like going forward. And I guess finding funds to restart your business might be difficult at this time if you haven't got all that information to present to, say, your bank or whatever.
Yeah, I mean, there is some help from the government in terms of restarting, but I think it's limited help. And there, sort of various agencies, including the ONS and the Bank of England, have indicated that there is likely to be a strong bounce back later in the year. But this is classic territory for overtrading. So where businesses engage in more business than they can support by the market or by the funds and resources available to them. So it might be that they don't have enough financing, as you were suggesting, Jenny. They may have exhausted their supply of financing. They could be quite heavily geared at this point in time. Or going back to a pub again, I'm not like he going back to the pub, but my local pub is struggling for staff at the moment. So they lost a number of people during the lockdown periods. People went off and found alternative jobs. And now the lack of staffing is actually affecting customer service, and you read the TripAdvisor reports and it's not great for them. You know, people are saying there's long waits, and that's eventually going to have an impact on the number of people that want to actually go and eat and drink at that pub. And there's also things like, you know, you may have exceeded all your credit terms with suppliers. I mean, suppliers have probably been waiting a long time to be paid in some industries. They may not themselves be able to be that forgiving anymore, because there may be significant pressure on them. So they may not be able to extend the credit facilities to you, and indeed may be looking quite adamantly to get their monies back.
Yeah, fair point. Well, thanks, Andrea. Tom, I'm going to come back to you again. So you've got your forecast, you've got everything, what things look like for the 1st of July, and actually the position doesn't look too good. What sort of things should a board be thinking about in this situation?
Well, the board obviously have a very difficult decision. They need to ultimately decide whether it's possible for the company business to continue to trade, assuming it's insolvent on the test that Sandra set out. As Sandra said, they need to consider the interests of the creditors and whether there's actually a reasonable prospect of return to solvency. Now, you need to bear in mind that it's the best outcome for creditors is typically that the company actually carries on trading and returns to solvency, which means all creditors are paid in full. But you have to look seriously and realistically as to whether that's a likely prospect. So the things we see businesses directors typically do, they might look to sell the company to someone who's got funds to invest or wants to take the business forward. Now, if you're looking at that kind of option, you need to be realistic as to whether a sale is going to be possible, and clearly whether it's going to be possible in the time frame you've got available. If your forecasts show you're going to run out of cash at the end of the month, there's very, very limited time to get a business sale through. If your forecasts show you've got cash for, you know, longer than that, 6-8 months, you may well be able to put a proper process in place to gauge advisors and have a realistic prospect of actually selling the company for some value. Now, as an IP, you'll look back and go, well, was it realistic that they would sell that business? And doing things like engaging advisors and getting information memorandums and actually putting it to market will be key in that, whether it's ultimately sold or not. Other areas where directors often look at is refinancing. You know, if you have identified a funding gap from the work you've undertaken, it's critical to know what that is, and you need to be realistic about if that funding's able to be raised. The difficulty people I think will have is they've probably already exhausted a lot of the funding, as Sandra said. The bank, if they've already had bank loans and CBILS loans, the balance sheet's indebted. It may be difficult to raise further funds, and so to rely on, you know, an overdraft or something that isn't forthcoming, again, directors could be criticised if that's not realistic. And again, restructuring, Jenny, you may need to decide to close a part of your business, close a product line, restructure how you operate. You might decide to go and work entirely virtually to save office costs. Now, if that is your strategy, and it may be a valid strategy, you need to properly cost that to make sure that you incorporate into that, you know, the cost of terminating your lease or employees early, and forecast how that will work, so that it is a realistic plan. So I think timing is critical, and being realistic and putting in some different scenarios in terms of your forecasting on that is realistic, not just hoping for the best.
Okay. And you may have a board of directors. Are all the directors responsible in this situation?
Yes, all the directors are liable to be have claims against them for wrongful trading and other things. Additionally to that, the insolvency practitioner can look at shadow de facto directors, so directors who aren't formally appointed but have effective control of the company. We've also seen trustees of charities facing similar issues, and they obviously have personal liability. But yes, Jenny, it is the directors as a whole who are responsible, and that does include non-executive directors who previously may have not had much of an active role. I think now they need to be fully engaged. They need to know what is going on and be sure that they're clearest to that, because they will be looked at in the future, whether they are or not.
Okay, and I'm guessing this is going to be a new situation for a lot of people to find themselves in. I'm guessing they should be taking some advice. What sort of people do you think would be good to talk to?
Well, I think you're absolutely right on that, Jenny. If you go back 18 months, you may well have had a perfectly profitable, successful company with not a worry, and then through no fault of their own or anybody really, the pandemic arrives. It wasn't foreseen. And overnight, almost in some cases, your business is under severe pressure, and you may have struggled through taking advantage of the schemes, and you arrive at where it's all reopening now, and these are all unfamiliar areas. So I think you're absolutely right. It's not something that many directors may have given much thought to until they arrive at this unfortunate situation. But in terms of taking advice, I think for some of the work that Sandra alluded to in terms of getting the accounts up to date, getting the forecasts in place, the company's accountants are the best place to help with that. If you haven't had management accounts, I'd suggest you need to keep a close eye on your business finances, and monthly management accounts can help you do that. If you didn't have forecasts previously, I think that's something to look at, and you can also model different scenarios on their forecasts. What happens if everything reopens as normal in June? What happens if it doesn't? What happens if there's another lockdown in the autumn? And see how resilient your business is to that. Again, you can speak to insolvency practitioners such as ourselves, or turnaround specialists in relation to reviewing the company's position, advice on the specific aspects of claims we might bring, or restructuring procedures, options available, and refinancing. Again, solicitors can obviously advise on the legal aspects, but in particular, if you are restructuring your business, you may want to exit a lease early, you may want to make some staff redundant as part of restructuring. So solicitors are key to that in terms of making sure you make those changes A, legally, and B, effectively as possible. And again, it may be you want your solicitors to look at the company's own terms and conditions with your customers to make sure they include provisions around COVID in the future, and supplier service and potential things that you may not even thought about, which could offer you some protection in the future. And I suppose finally, the may not be directly linked to wrongful trading, but a lot of businesses have gone through a lot of change, and it's worth speaking to your insurance brokers about changes that you could have on your policies. Are they fit for purpose? Do they include staff working from home? You could save some money, but at least you can be clear you've got the cover. And also, you may want to look at a D&O policy, which gives directors some protection from costs, etc., if claims are brought.
Okay. I think in the bit before last, you mentioned about all the directors being informed and engaged. How would you go about that? How would you make sure that happens?
Sure. For larger entities, you would expect board minutes are supported by management accounts or financial information of some sort, recording the decisions that were made and the discussions that were had. I think that's fairly easy for a board of a larger company to produce. They're normally circulated, and the board members, are fully aware of them. For smaller owner-managed businesses who may only have one director, that's obviously more difficult. And whilst they may, in their head know what's going on, I think it's absolutely key that they have a written record, even if that's just an email to, someone else in the business or their accountant, just to say, what they knew, what decisions they're making, and the rationale. So that if they're later asked, with the benefit of hindsight, what did you know, what was going through your head at that time, there is a written record of that thinking.
Yeah.
And clearly that needs to happen fairly regularly.
Yeah. I guess as with a lot of sort of distress situations, communication is key, and making sure you're talking to the right people, and probably your bank as well. You know, my background is with banking. Nobody likes surprises, do they? Everybody likes to be informed and know what's happening and what's been going on.
Yeah, well, I think you're absolutely right on that. Engaging with the business stakeholders is generally a sound approach. I'm sure a lot of businesses are doing that already with the pandemic, and I think that's absolutely right. No one likes surprises. It's worth saying, of course, as well, directors may want to take some personal advice. Wrongful trading is a claim against the director. There may be other personal implications, and the director may want to take personal legal advice in relation to anything they have concerns about.
Yeah, no, that's a good point, actually. So could there be other implications for directors then?
Well, directors personally, yes, there are a few things they should be aware of. It's possible for a director to be disqualified. The government can apply for a director to be disqualified if, following the insolvency practitioner's investigation and report, they deem that a director should be disqualified. So if an IP found evidence of wrongful trading, that would no doubt be reported to the insolvency service, and they would look at that. Although it is generally only the more serious cases and the cases where there's a public interest, where the insolvency service look to take action in that regard. But again, there is risk of disqualification. And of course, you have, as I mentioned earlier, you may have had a perfectly successful business 18 months ago, and now you're facing, hugely difficult, uncertain times. You're facing potentially a business failure. You're facing potential claims, and so that has a personal effect on the mental health of directors, their family life, their personal finances, and it's probably come as a shock. So it's not certainly worth bearing for directors. It can be a hugely stressful and distressing time.
Absolutely. No, thanks, Tom. Sandra, I'm going to come back to you. How many businesses do you think are going to find themselves in this wrongful trading trap, where they're in the same position pretty much now as they were March last year, but actually all the things that were put in place to protect them are gradually being withdrawn?
Yeah, I think that's very much the case, Jenny. I do feel for directors out there that find their balance sheet in a fairly precarious situation. And I certainly think that if we apply some of the aspects of the Rolls case to what directors might be thinking of at the moment in terms of with the suspension of wrongful trading lifting, what should they be thinking about? Well, they should be checking their balance sheet. Is it insolvent? As I was saying, it could be in a lot worse position than it was at March 2020. Is there creditor pressure? Not only are the suspension of the wrongful trading provisions being lifted at the 30th of June, also the suspension of the winding up petition regime is also being lifted at that point in time. So there could be some significant pressure there.
So I'm a director of a business, and we're going to assume I'm reasonably diligent.
We should.
What sort of thought process can they go through to satisfy themselves, really, I guess, is that what they're doing is the right thing for their business, and that there is a reasonable prospect that is going to get them to where they want to be and allow them to continue trading?
Yeah, so that's sort of around the avoidance of an insolvent or liquidation or administration. Yeah. So I think it's about what we have said previously, both Tom and I, about keeping those accounts up to date, checking the forecast, ongoing reviews of the financial position and seeking help if necessary. I think really understanding that greater debt burden, what the size of the net deficiency on the balance sheet is, and realistically how long it's going to take to repair that balance sheet. So if it's a matter of months, that's one thing. If it's several years into the future, is it appropriate to continue to trade at that point in time? And And what are the directors' rational expectations that the future might hold? Now, this could be very industry specific. So if some businesses have done quite well through the pandemic, whereas others have suffered much more greatly. So if you look at things like the travel and hospitality sector, I think uncertainty remains certainly in the travel sector for some time. So what is the rational expectation of those directors? Is it that trading will commence as normal within 3 to 4 months, 6 months, 12 months? What is it? And certainly in some of those industries, is stop-start the new norm? And should this be built into forecasts? You know, this will be, obviously, as a much more relevant to some businesses than others, but maybe you can draw on your experiences over the last 12 months. But we obviously have to remember that directors are not clairvoyants. You know, they can only make decisions about continued trading, etc., in light of what they know at the time. Okay. And taking professional advice. I mean, I think we keep coming back to that point.
Yeah, I think that's crucial, isn't it? Absolutely essential. So if you get to a situation where an insolvency or a liquidation or an administration can't be avoided, that's where we're going. What would a director do whilst trading on to ensure that they are taking every step, which I think was another phrase the judge used, every step they ought to take with a view to minimising the potential loss to creditors?
You usually say it's a very high hurdle, or the judge commented on that for sure, taking every step. I mean, I think you need to be acutely aware of the financial position, what the net deficiency is, and what the creditor position is. Any trading on should be designed specifically to decrease that net deficiency. It's obviously having those detailed forecasts and reviewing those against the actual results very regularly. It's about avoiding incurring unnecessary credit. It's about avoiding swapping one creditor for another, more likely to go to preference than or fraudulent trading than wrongful trading, but still that's an issue for directors. I suppose if you're engaged with your stakeholders, the creditors with your plans, for example, you know, maybe it's the landlord that you need to come to an accommodation with, it will be hard to argue wrongful trading if that creditor agreed to that proposed trading on. The stakeholders may well be taking a much more flexible approach. So, you know, perhaps the landlord doesn't want a whopping great big factory that's empty for a long period of time if this sort of almost wind down trading could provide a better result for them. It's important to remember the directors can be paid during this point for their work that they do, reasonable salary, as the judge referred to. But it's also important to note there's no requirement for the directors to trade on in this situation. They are opening themselves up to potential risk of a claim from a liquidator or administrator to contribute to the assets of the company. So it's important that they make that decision, you know, in the full knowledge of that. So again, we come back to taking professional advice, I'm afraid. It certainly remains an uncertain outlook. But the protection for the suspension of wrongful trading will be gone shortly if they don't row back on the situation as it's, you know, described at the moment. We are going to have a lifting of that wrongful trading suspension as at the end of June. And that's where we think that directors really need to be very careful about the wrongful trading trap at the very point in time when perhaps they could do with that protection is being withdrawn.
Absolutely. Well, thank you both, Sandra and Tom, for sharing all those bits and pieces, and hopefully everyone's found that useful. We're going to finish off with a quick poll around the extension. You won't be surprised to learn that we Googled it this morning to make sure it hadn't been extended. The trouble with doing these webinars about something being changed is there's always a good chance they might change it back, and there still might be. So, but be interested to know in your thoughts whether or not they should continue to suspend it, or whether actually enough's enough now and we should move on to back to normal, as it were, or the new normal, as people keep saying. We've got a couple of questions coming through on the Q&A. So while you guys are just answering that, I'm going to ask Sandra and Tom, I'll probably come to both of you on this. Excuse me. Bearing in mind, continued trading in this environment may require new funders to pay off historic creditors, do the panel think it right that directors can escape legal liability for wrongful trading, even though they ought to have known liquidation was inevitable and haven't taken every step to mitigate, solely because the net deficiency did not increase? Is the threat of disqualification and/or compensation orders a sufficient disincentive against directors trading on beyond this point?
Right, well, that's a very good question there. And if you look at the Rolls case would suggest that solely because the net deficiency did not increase, the directors were not liable to contribute to the assets of the company. Now, whether that's right or not, and whether the legislation regarding wrongful trading ought to be changed, is probably a matter not for me, but for Parliament. Is the threat of disqualification or confiscation orders sufficient disincentive? I probably don't think it's very up there in directors' mind when they're sort of battling these decisions as to, you know, how they keep things, the spinning plates going. I don't know, Tom, do you have a view?
Well, I think if you put I think the danger for the directors are that you're so used to surviving the pandemic, you don't really stop to think, is that now appropriate? Which is what we would encourage people to do. Now, if they ought to have known, it's quite interesting. The question says ought to have known, not knew. So if you said you knew, well, I don't think it would be right to say someone ought to have known. Well, I think it's still hugely uncertain and difficult. So if you want my view, as Rolls said, if the creditor position didn't worsen, the remedy is to restore the position. There is nothing to restore. It's not right, but they may well have done some other something else which could give rise to another claim, which I suppose is where you could take it from then on. Misfeasance or transactions defrauding creditors, etc. If they've misled creditors in that respect, which could be the other remedy that creditors could have, or the insolvency practitioner.
Okay, thanks, Tom. I'm curious to see the results of the poll. We were split on the panel as to what people. Interesting.
We really didn't know where this way would go, did we, Jenny? When we proposed it, we thought we sort of guessed the first poll answer, but we didn't really have an idea on this one. But that's quite interesting, I think.
Yeah. Well, let's see what they do. I mean, maybe they will have a change of heart. Yeah.
Enough is enough, I think, is what people are saying, perhaps.
Yeah, absolutely. And I'm conscious of time, so I'm just going to finish off on one last question for Sandra and Tom. Do you think we're going to start to see more wrongful trading claims being brought as we move forward? Sandra first.
Okay. I think that it will be hard for liquidators or administrators to ignore the potential wrongful trading claims. Indeed, we do have a duty and obligation to look at whether we can increase the pot for creditors. I think the difficult bit for us will be in establishing whether the directors knew or ought to have known. I mean, it is very uncertain times, and the reasonably diligent director, what was in their mind at the time, and I think that's going to be the difficult bit for insolvency practitioners to persuade the court on.
And I think the attitude of the court, I think, the COVID defence for directors will be there. You know, this was suspended. They will probably seek to rely on some of that, the benefit of that suspension beyond the 1st of July. It was still uncertain. Why should, even though the suspension's been lifted, the facts from their point of view are the same. So I don't know how forgiving the court might be when making these determinations, given you have a director who's in an invidious position often. So I think it'll be interesting to see when the first few cases come through, how the court respond to those kind of COVID defences when they're put together.
Excellent.
So I think more potential claims, but whether or not there's any whether they're successful, I think, is or brought or successful is a different thing.
Okay, thank you, Tom. Okay, well, I think we've overrun a little bit, so I think we'll wrap up there. I just want to really say thank you again to Sandra and Tom for sharing your knowledge and expertise there. And our contact details are up on the screen there, so I'm sure if there's anything you want to pick up with them, they'd be more than happy to answer any questions. Thank you so much for attending. Zoom calls and webinars are one thing, but I'm hoping that as we start to open up again, we'll start to see some of you face to face, perhaps over a beer or a sandwich or coffee, whatever. It'd just be nice to see some real people face to face. So please keep in touch. Think of us if you have any clients that are struggling, get in touch and we'll hopefully we can help. Thank you very much.
Looking forward to seeing everyone again in person. Take care.
Bye.
Bye.
Bye.